Valuations for many stocks in the S&P 500 are at sky high levels. And for many of these companies, the math simply doesn't add up, which can prove catastrophic historically for investors when the music stops playing. Welcome to Retire with Ashley, your guide for preparing for and living your best retirement. I'm your host, Ashley Micciche, and today I have with me on the podcast Kevin Caron. He's the senior portfolio manager and co-founder at Washington Crossing Advisors. And back in September, on September 9th, 2025, he published a piece on his website titled The Illusion of Perpetual Growth. And that was really the catalyst for having him on and doing a deeper dive discussion, because I read this piece and I was like, holy cow, this kind of summarizes what I've been concerned about for a pretty long time, which is that the valuations of the stock market in general, and in particular, a lot of individual stocks, is pretty stretched. And when you have that situation where the valuations are high, inevitably, historically, it leads to lower returns in the next 5, 10 years, as is often the case. And so I wanted to have him on to talk more about what the current valuations for many stocks in the S&P 500, what that means for investors, and how should we think about this market? How can we prepare for both continued growth, which is certainly possible, but also some of the downside risk as well? So, Kevin, thank you so much for being with me today. It's an absolute honor to have you here on the podcast.
Yeah, it's great to be here. Thank you.
Yeah. So, okay. So if I go to your website now, I went and checked this morning, there's an insights section. So if you go to Washington Crossing Advisors website, insights, and you scroll down, because you guys publish new content all the time. But if you go down to September 9th, 2025, you can find this piece that I'm referencing, and I'll also link it in the description. But in this piece, you argued that a pretty fair amount of companies in the S&P 500 today are valued based on pretty lofty growth assumptions. And where you also argue that the math on this simply doesn't work. So I was hoping maybe we could start and frame this whole discussion by explaining kind of your findings, and breaking that down more in
Sure.
that particular piece.
Okay. So the stock market today has now eclipsed $70 trillion in value here in the United States. And those are just the public companies. Many of your viewers are probably aware that over the last number of years, private equity has also played a role in public markets and essentially have taken private many companies that used to be public. And the estimates of the value of those companies, they vary, but $20 trillion is a reasonable guess for what the value of those companies are. So add together those two numbers. You have currently public companies now worth $70 trillion, and you have private equity, also known as formerly public companies, that are worth about $20 trillion. So you have about $90 trillion of value. And what is supporting that fundamentally? Well, it's being supported by an economy that's about $30 trillion in size. So when you think about those two things and understand that the value of stocks in the United States, value of equity, is going to be driven by how big the economy is, you have a very interesting ratio. You have the value of companies that's 3 times higher now at $90 trillion versus a $30 trillion economy. And that's just a very big number. This ratio of market value to the underlying economy, that's something that Warren Buffett popularized many years ago and wrote about it in his writings. And if you think about where we're starting, the fact that equity values are very high, what it implies is that going forward, while we've enjoyed a very good run of it the last decade or so, going forward, the returns should be lower, and potentially where you have unreasonable expectations, the volatility could be much higher than many people currently think. So particularly for people who are at or in retirement, who are in that distribution phase of their life, the idea of taking a giant step back is obviously not a desirable one. And so all we're saying is that it's important to think about what you're paying for things, especially today, given that there are pockets of the market that have gotten very expensive.
Hmm. Okay. So, I mean, the narrative that I hear over and over again is that AI is completely going to change the economy, the way we live, everything. And it's very similar to, what the internet, what happened with the internet 25 years ago or so. And so, um, is that the primary driver of optimism today and why stocks, because it's not just a handful of companies in your piece that you argue, quite a large number of the publicly traded companies right now are priced with pretty optimistic valuations. Why is there so much optimism today that's driving stock prices continually higher and higher?
Okay, so there's a lot of investment that is happening, and a lot of it is tied to AI, as you might think. And the market, like a ship, has tilted fully to one side. So when you look at the excitement around AI and the investment, it's very easy for investors to become enamored with what they're seeing. And when we look at flows, when we look at where the interest is, almost all of the interest, all you have to do is look at the news headlines any day or turn on TV and watch what people are talking about. There's an obsession with AI, and perhaps rightly so. It is a significant new technology, but it, even that can become excessive. So if you go back to 1999, you look at the internet. The internet, in fact, ultimately changed everything. It changed the way that we lived. But there was a point in time where the enthusiasm over the internet created a whole bunch of expectations that were very difficult to meet. So you had many stocks that were involved early on in building the infrastructure for the internet. Remember, for example, a company like Sun Microsystems doesn't even exist anymore. But back in the day, that was seen as very important. And there was a time where America Online was the most highly valued company in the United States. It's been a long time since I've heard You've Got Mail. So there are a lot of things that are easy to forget, but and it's not to say that all companies that are at the forefront of AI today are going to end up like Sun Microsystems or America Online. But I think when you look at how they're being valued, the growth expectations that are priced in today are somewhat unreasonable. And the mathematics of it is very simple. There is a way to back into what the market's expectation for growth for now and forever is in any given stock. And when we do that math, when we consider what the market implied growth rates are for many of these companies, what you get are growth expectations that are in the mid-teens, 15% or so. Now you might say, well, that's no big deal because there are a lot of companies that are growing a lot faster than that. Yeah, that's today. But the growth I'm talking about is growth in perpetuity. And that would imply that if you had a company grow 15% a year, for example, uh, eventually in an economy that's growing 5 or 6%, that company would eventually become larger than the whole economy itself, which obviously can't happen.
Hmm.
So there's a disconnect, and there are some signs today that the math just doesn't add up. And so all we're saying at Washington Crossing is just be a little bit careful and make sure that when you're buying stocks and you're thinking about growth, which is very exciting, especially as it relates to AI, just recognize that valuations sometimes can get out ahead of what is ultimately likely to be delivered.
Hmm. Well, yeah, and there's so many other things too that I notice with. So the stocks are priced based on just the sort of general assumption that AI is going to completely revolutionize every aspect of the economy without any detailed knowledge about how or why or who those winners are going to be, because there's always going to be winners and losers. And it's funny because I hear a lot of, especially among skeptics, not necessarily that AI is going to not completely change everything, even in the next few years, but that we don't yet know, and nobody yet knows how companies are going to make money off of this yet.
Mhm.
And so there's still a lot of uncertainty around it. And it does remind me of the dot-com bubble in that it was similar types of companies involved, big tech companies. Um, there was a lot of enthusiasm over how the internet was going to completely change everything. And all of that was correct, but it seems like a lot of the companies that were sort of left in the rubble of the aftermath were the ones who had overspent and building out the infrastructure. They were just a little bit early to the party. Like, do you see that also playing out today? Because I think one of the main differences between the dot-com companies back then and the companies who are dominating the current landscape in tech right now, they're most of them are highly profitable. They have really strong cash flows, good revenue. They're not like the zero revenue companies like the pets.com that we all remember from the dot com. So they look a lot different, but they're also spending enormous sums of money to try to win the AI arms race. So how do you kind of square those similarities and some of those differences?
So when you think about when you think about what a business does, they invest money, and then this money is money that is provided by somebody, either a creditor or an owner, and then that money that's invested has to earn a return. So what you're seeing today is a lot of spending on infrastructure, and this is capital spending that is going to ultimately require a return. There are estimates out there that McKinsey, for example, I believe estimated that there's projected to be $5 trillion over the next few years in building out just the infrastructure to allow AI to work. That's all money that has to earn a return. So it's either money it's capital that's either been borrowed or provided by owners. And ultimately, that infrastructure has to be put to work to generate revenue that ultimately justifies the investments that are being made. Now, the more capital that's expended, the more revenue is going to be required to be earned in the future. And that becomes a rather difficult task, especially when you recognize that there's so much capital being put in place here. And there's so many companies that are currently operating, coming along, that are going to be looking to move into this space, that you have the potential that it's going to get very difficult for all of these companies to be successful. So at Washington Crossing, our expectation is that we will go through a period where there will be a washout, where you're going to have some companies that are going to make it. Maybe some of them are going to be very, very successful in earning a return on the capital that's being invested. But there's also going to be companies that aren't going to be able to make it. It's a very, very competitive area. It's likely only going to become more competitive, but eventually companies are going to have to earn a return on it. So the Sun
Mhm.
Microsystems, America Online of the world that dominated in the late '90s, those are not with us anymore. And ultimately, it's going to be the applications that are able to generate revenue that are going to be the ones that are going to be most successful. And we don't know what those are going to be yet. So as the
Mhm.
infrastructure is built out, as AI is built out, there are going to be companies that we don't even know exist yet
Mhm.
that are likely going to be ones that are going to be able to exploit and ultimately win. But it's going to be a longer game.
Yeah. Well, and I've read articles too about how the infrastructure, like the electricity grid and what we have currently, can't even support the full picture of the AI build out anyway. So there are roadblocks too that are outside of the control of many of these companies. And then you hear about some of these big tech firms that are like trying to reopen nuclear plants and kind of try to solve the problem on their own so that they can continue the AI build out. How soon do you think investors are going to start expecting or demanding results. Because when I watch interviews about AI, not even from an investment standpoint, but just I'll watch like a 2 hour long interview with like the godfather of AI. And this guy's talking about how in a couple of years there's going to be massive change, and there's going to be a lot more automation and a lot more business application within the next year or two. And so, but it doesn't seem like we're that close yet, to because a lot of companies are still experimenting with this. There was an MIT study that was published earlier this year that said the companies who are trying to implement AI in their businesses, that like 95% of them are failing, they're unprofitable. So there's a lot of, two steps forward, one step back, experimentation, trying to figure out how do I apply this in a business scenario where companies can make money. And I wonder how much longer the stock market will, and investors will allow this sky high growth without demanding results.
Okay, well let's pull that apart a minute. So ultimately, the users of the technology would be businesses that are that have some ability to improve their profitability by employing AI. Then these are not the companies that are building data centers necessarily. These would be every company, Main Street America, companies that have been around for many, many years, who suddenly find that there are efficiencies to be gained from the new technology, which should benefit everybody. It shouldn't benefit the companies themselves, it shouldn't benefit their employees, benefit society more broadly in many cases. So those opportunities, that represents the revenue that the AI providers, the builders of the data center, would hope to employ and convert into revenue that justifies the investments that are currently being made. So
Mm.
so that there are really two different parts of this. And at Washington Crossing, we think there's huge ability for this technology to be absorbed into the rest of the economy. And that is something that's very real. That's going to take years to play out. In the meantime, when you have an investment boom, what tends to happen is you tend to get rising revenue, rising profitability within the ecosystem that where that investing is happening. So investing tends to recycle back into businesses that are making the investments. So ultimately, you're in a period right now where growth is being validated, where you see revenue the more companies are spending to build out the data centers, the more revenue you're seeing in the ecosystem. And it becomes a little bit circular almost, but this is something that is well understood in the economics and finance, that as investment is expanding, you tend to see in that moment a increase in revenues and profits. However, there will come a point where markets will stop and they will say, okay, take XYZ company that's investing heavily in AI data centers. At some point, the market's going to say, wait a minute, we're pricing in 15% growth forever, and we now need to see return on that investment. And if that isn't forthcoming within a reasonable period of time, where there is some visibility, let's say 3 to 5 years out, if that doesn't materialize, then investors can get very nervous. The momentum would stop, the prices would stop rising, and then the question would be, well, why are we buying the stocks if there's no momentum here? And so that
So
typically
why
signals a interruption in the process.
So why do you think that hasn't happened yet? Because I think as loud as the drumbeat is about AI and the nobody wants to miss out on the AI and jumping on the bandwagon with all of these stocks. But there is a healthy amount of skepticism, and I would also say anxiety about what's happening. So why do you think it's just too early um, for investors to be calling for like some more concrete timelines? Or why do you think investors haven't demanded more answers about where
Yeah.
these companies are?
So there are two big forces in finance. One would be momentum, and then the other one would be fundamentals longer term. And if you look at how markets behave, the very often you find that momentum dominates in the near term. So as long as things are going up, as long as the trend looks positive, it puts a lot of pressure on people. It puts individuals feel the fear of missing out. My friend bought in, they're making money, I should be making money too. You have professional people who are tied to benchmarks, and there's pressure to perform in terms of just performance, keeping up with benchmarks. And we all know the S&P 500, you have 4% of the companies now that represent 50% of the index. So this has become so whether you're a professional person, whether you're a individual who's looking to profit from this, there's a lot of pressure to keep up with momentum. However, like electromagnetism will, you can suspend something by a magnet and overcome gravity. But in the end, ultimately, it's gravity that wins. And fundamentally, businesses are not able to generate the profits that justify the investments, then ultimately fundamentals will, in the long run, win. And this plays out over and over again in just about every corner of finance. It always has been and always will. But momentum and valuations are the bookends of the process. So we are now in a process where momentum is overcoming, for the time being, valuations and fundamentals. But in the fullness of time, if the profits don't materialize, there will be a weeding out process where winners and losers are decided by the market.
Mm-hmm. Yeah, and another way there's this chart I always think about when you look at the mood of the market, and euphoria is always the defining mood at the top, and on the way up you kind of have optimism, and then excitement, and then there's that fear of missing out, and then you have euphoria at the top, like I'm a genius, this is the only way to invest, things are going to just keep going on forever. And then, of course, on the way down, you have the anxiety and the fear and the panic and all the things that sort of define where the market is. And I don't know that it's a good predictor of where things are headed, but I always try to take a pulse just in talking in my very, limited view of the world and the things I read and talking with clients and trying to figure out, well, where's the mood of the market generally right now? Is it still on the way up? Are we to the point of euphoria yet? Like if you were to characterize the mood of the stock market today in one word, how would you characterize the mood of the market right now?
Optimistic, very extremely optimistic. Uh,
Overly optimistic. So like
well,
you
look, markets don't have moods. People have moods. Markets don't have moods. But what I can say
right.
is that there are telltale signs where markets have made a mistake or are likely to have made a mistake. So for example, unless you believe that there will never be something that goes bump in the night, unless you believe that there will never be a slowdown in the economy or a recession, then if you got to a point where investors were not being paid for taking on risk, that would be a disconnect, because I think for most of us, I think we all understand that there are good times and bad times. So it is possible that a market that is caught up in a lot of momentum will overshoot the mark. And when you look at things like credit spreads here in the United States, the difference between corporate bonds and treasury bonds, let's say, those spreads are very, very, very tight, almost as if the bond market in that case has decided that, well, we're never going to have a recession again. Now, someone who you might look at that and say, well, that's probably not right. It's likely that someday something will not go right, and consequently, the market has mispriced or is overestimating the likelihood that things will, go on as they currently are for, forever. So those kind of things, it becomes a point where rationality, at some point, the market will wake up, reassess growth expectations and the like, and ask for compensation for risk. And those things can happen, like that. The market will just one day it's very likely that the market will reassess. Well, it does, as it does every day. But if profits are not if profits ultimately are not there for these investments, or the growth rate is less than what the market is currently anticipating, the market will change the valuation of these stocks so that they are more so that they reflect reality and
Hmm.
long run fundamentals. We're just not there yet.
Hmm. Yeah. Do you see signs that the market is in a bubble or in a growing bubble? Or do you think that we're not in a bubble?
It's always easy
Where
to
do you,
it's
where do
always
you plead the fifth?
well, no, it's always easy to spot a bubble in hindsight. In
Yeah.
1999, we were in a bubble. I'll bet you that if we asked any one of your viewers, I got a deal for you. We can go back and buy stocks, but you have to pay the highest price in 1999. Most of your audience would say, "Yeah, of course I'm going to do that because the market's much higher now." So we do go through points where the market I would just say, gets ahead of itself. And when
Mhm.
expectations are higher than what's likely to come, either growth expectations are too high or investors are asking for too low compensation for taking on risk, or both, which is probably the case today, the market can get ahead of itself. And so
Mhm.
I think that ultimately, if you're looking at somebody who's thinking about the market, who's in retirement, maybe these are even the wrong questions. We have found that it makes a lot more sense to be thinking about something as mundane as what's going on with the dividend. Are the companies do we own? Are they producing some income so I can live in retirement? Is there something by way of growth that the companies are providing that's at least growing in line with inflation, which is 3%,
Mhm.
4% today? Those kind of expectations are actually fairly achievable, and there are actually lots of companies out there today where you can get that kind of security without having to go out and buy companies that are trading at really, really, really high multiples, hoping that someday the revenue eventually materializes. I think that
Mhm.
the questions you ask as somebody who's in retirement might be a little different than somebody who's just looking to, well, beat the market, if you will, today.
Right. Yeah. And nobody wants to be sitting in a pile of overvalued stocks when the repricing occurs and when things come back down to reality. The problem I find in just talking with my own clients is that when you look at how a performance of a good quality dividend or sort of more value tilted portfolio is doing versus the S&P 500 versus a lot of the big tech versus the Nasdaq. It's like I'm missing out on those returns over there. So there's this greed factor that comes in as well because and investors, even those who want to be more conservative, who are closer to retirement, they can't help but compare how they're doing to the overall market and the S&P 500 and think, gosh, like uh, I'm missing something.
Sure.
And so I think that's what's the most challenging part for people who are getting close to retirement, who are in retirement, because you can build a fantastic portfolio of good quality stocks that can provide income and reliability and be stable. But those have been out of favor for such a long time now, for many, many years. Investors, I think, find it hard to say, okay, yes, I want to sign up for that. When I think they also assume that they're going to be able to take that pulse on the market and be able to kind of reposition themselves when things do turn, when we do have a downturn in the markets that is prolonged. They're going to kind of know when to get out, I guess, is another challenge that I see. So yeah, investor behavior is definitely unique. I haven't experienced this kind of fear of missing out psychology among a lot of people, even those who are close to retirement a long time, my clients who have, higher concentrated positions in riskier stocks are very reluctant to even not even like sell all of it, just taking off some of it. So it's an interesting time to be an advisor, in your case, be a money manager and kind of making these decisions based on keeping the long-term view in mind, when there's so many things that maybe don't necessarily make sense about why stocks and why the market is behaving the way it is. That'll do it for today's episode. And a big thank you to Kevin Caron for being my guest today. Thank you so much for watching. My name is Ashley Micciche, and this is Retire with Ashley. Be sure to like, comment, and subscribe. I'll see you next time.